Hello again, my name is Louise Jackaman, and this time in our Equity Masterclass we will be looking at security market indexes or indices. Use whichever you prefer. I'm sure I will be using both. Okay, so our focus as ever is on basically getting you through the exam on this, but also just understanding how things pin together, and also any real world examples that can just help these concepts stick in your mind. So the main focus here has to be on being able to do the number crunching, and from the number crunching comes an understanding of what it is you're doing and hopefully why you are doing it. So then we can understand perhaps the benefits and drawbacks of different methods of creating indices. Now, we all have hopefully an awareness of what an index is. In my country, in the UK, on every major news channel or news broadcast, there will be a comment at the end on what the FTSE 100 is doing, which is encompassing the value of, well, what people think are the 100 biggest shares in the UK, and that they may well be, but maybe they don't know the details of how those figures are put together, or indeed what those companies actually are and where their focus is. So we need to appreciate the mechanics of how these indices are put together and any issues with them. We also need to understand that it's not just shares that have indexes, although they may be the most popular and widely quoted. Fixed income, i.e. bonds, commodities. We have indices for all sorts of things, but they're maybe not as easy to put together. They maybe have their own issues. And actually understanding the underlying securities or investments or asset classes means that we can see why trying to create a running single number that shows what they are worth on aggregate may not be so easy. So if you have not yet studied fixed income or alternatives, it may be that final section on equity and non-equity indices doesn't quite make so much sense at this stage. That's fine, park it. Just remember that you need to come back and look at it once you are more familiar with fixed income and commodities. Okay, so we've got a nice summary here of the various types of methods that you can use to construct your one number that kind of shows the health or the value of a whole load of underlying stocks. So we've got price weighted, which obviously we'll go through all of these with a numerical example, but price weighted, which in some ways is the simplest of them all. So how many stocks are being covered by the index? And we just start off assuming we've got one of each. And then we just keep tracking what one of each stock does in terms of total value. Equal weighted, not so widely used in practice for reasons that will become apparent, but basically it's about the rebalancing issue, is that you imagine your portfolio is equally spread across all possible investments. So if there are 100 possible stocks you could invest in, 1% of your portfolio is invested in each of them. Now, the problem with that one, it's a nice idea, but the problem with that one is that as share prices rise and fall, that initial 1% is no longer 1% of your total money invested. So as a result, you have to keep periodically rebalancing the amount that's in each of those 100 shares. And that just becomes a transaction cost and an admin nightmare. So that's why it's not done in reality so much, even if it's a nice idea. Market cap weighted, or its sort of closely linked version, free float adjusted market cap weighted, is perhaps the one that most accurately reflects the investability of shares. So bigger companies can absorb much more investment. There's a greater value of shares around. So the importance of one share in, for example, Vodafone or Exxon or something is more important than one share in a smaller company. And fundamental is really the outsider here. We'll come to it in due course, of course, but it's where you look at the underlying factors within the company the thing that gives it value, which might be to do with its earnings or its dividends or something. And we weight our investment according to those factors. Okay, so it's sort of separate. The first three can all be done with some fairly straightforward numbers. You can't really do a calculation so easily on fundamental. It's less likely to be something you'd have to do numbers with in the exam, but you may be asked to talk about what it is. Okay, so we're going to use this information, shares or stocks D, E, F and G, and we've got some information about them all. We've got the beginning of period price, that's the BOP price, beginning of period price, and the end of period price. And in addition, a dividend has been paid. So that's not wrapped up in the end of period price. And the reason we've got that information is because, of course, when you invest in a share, you get capital gain. So look at share D, that's pretty good, 10% capital gain, but you also get a dividend too, which is, in percentage terms, another 4% return, isn't it? And often with these indexes, we focus on price and we forget the fact that dividends can be quite a major part of return. So have a look at those stocks and just think, right, knowing how the indexes are put together, is there perhaps one of them that might bias the outcome? So for example, which one's done the best on its own in price terms? That will be stock F. So that's gone up 50%, hasn't it? So if there is a method of weighting where F gets quite a lot of importance in the calculation, then we'll see quite possibly quite a high return. Have any of them gone down? Yes, E has gone down. So if there's any weighting method that might give E quite a high weighting in the calculation, we might see the results not looking so good. Okay, E also went down and didn't pay a dividend. So E's pretty bad on both counts. So what we're going to be doing is working through the following calculations. Now, I'm a big fan of people actually doing things rather than listening to other people doing them. So I really would stress the importance of just trying to do this yourself first. So go back to slides, have a look at the numbers and just see if you can work through these. And then I'll assume that when I'm going through things, you're already familiar with the numbers. You've already had a stab at things. Okay, but before you do it, just make sure that you're set up to do the right thing. So it is price weighted first of all, but easy to get confused here. The weighting description, i.e. one share in each or one stock in each, is separate from saying that we want the price return. Price return just means that we're ignoring dividends. It's just the share price. Whereas the second one, we're doing equal weighting and we're doing total returns. So that means we include dividends as part of our return. And then market cap with and without free float adjustment. We'll do without first of all and then move to with a starting index value of 1,000. Okay, and that's price return. So we're ignoring dividends there. Now also in part one, we've got a 2-for-1 stock split. So there become twice as many shares or stocks in share D or investment D than there were at the start of the period. So all else being equal with a stock split, you'd see the number of shares double and the share price halved. But we don't want that to cause a change in the index value when nothing really fundamental has changed. So your question is, or the question for you is to just think, how would that get adjusted for? Now, which is of course in the module, but can you remember what gets adjusted and in what direction? Okay, so I am now giving you suggested guidance to go off and try the calculations yourself, and then I will run through the numbers with you. Okay, so are we ready to go through them? Price weighted, one share in each. So nice and easy from a calculation perspective. So you just take your starting value of the index by going one share in each, add them all up, and we gave you a starting index divisor of 4, which basically means you start this index and there's 4 stocks in it. So what does it come to kind of on average per share? So 22.5 is your starting value. Ending value, no stock split going on at the moment, 24.5. So that's what your starting and ending index value would be. There was no requirement to give it a starting value of 100 or 1,000. If they did though, you could just work with the percentage change here and apply that to your starting amount. But your price return is what's happened over the period. As a percentage, we have seen an increase of just under 9%. Okay, now that question of the stock split. What do we do with a stock split? So the exam question could just ask you, what do you do to the stock divisor to stop the stock split pulling down the index? And that's the thing to remember, is that if you didn't do what we're about to do, this adjustment, what would happen? Stock D, rather than being 55, would drop to half of that, which would pull down your ending index. But nothing really has changed with the company. It's just got twice as many shares and the share price has halved. And also remember, if you were an investor in stock D, in company D, you would be given some new shares. So your investment would per share halve, but number of shares double. So there should be no change in what you feel as an investor. So if we kept that index divisor at 4, the index would be pulled down wrongly. So what we've got to do is reduce the index divisor, and that will keep the index at where it should be, which is 24.5. Okay, so you could just look at whatever answer is showing a bit of a drop in the index divisor. So we know it's got to drop down a bit. Or you could work through the available numbers and put them in. I think sometimes we've got to remind ourselves that the examiners will put in the correct answer there in front of us. So if we don't want to get to it from first principles, we can just put in the 3 options in turn and hopefully one of them will come out right. Anyway, when we drop the newly halved stock D value in, we want to make sure that when we divide it by the index divisor, it still comes to 24.5, and that works when the index divisor drops down to 2.8776. Okay, so it's quite a big impact on it actually, and that's because stock D is the biggest single price stock. Now that, of course, also comes back into the original question, bias. So stock D, the first one that we've got on our list, is the single highest price stock. So what it does will dominate what the index does, because it's just kind of naturally got more of an importance in the calculation, even though if it's just one share, it's a big part of the number. Okay, equal weighted index. There's a long way round and a short way round. And we like the short way round. The short way round is to just go, what's each stock done, and just take an average of that and use that average to move the index. Okay, now it is the total return, this one, isn't it? So it's not just the change in price. We also have to add in the dividend as well, which we assume for the sake of ease that it came at the end of the year, and we don't worry about time apportioning things in this part of the curriculum. So D, as I mentioned at the start, has shown a 14% return. E has had a bit of a shocker. That's dropped down 12%. F has had an amazing time. So F has gone 50% up in terms of price and has paid a dividend. So it's a 60% return for your holding in stock F and a 24% return for your holding in stock G. Capital gain plus income. So we just do a simple weighted average of those, and that tells us that the average percentage change in those 4 stocks is 21.5%. So we can apply that 21.5% to our index, showing that its index value is 1215. So even if you're asked for the index value and you think, well, I don't need the percentage change, it is just quickest to go through that percentage change route to the calculation. Okay. So we said that one's not used a lot in reality. The next one is. So market cap weighting means basically you're weighting each price by how many shares are available to invest. So big companies, big market capitalization, of course, meaning just number of shares times share price. So you could think of it as a weighting factor, or you could just think that you work with market cap figures, market capitalization figures. So you multiply across, and that gives you your total market capitalization at the start. This is price returns, so we're not worrying about dividends. Of course, we could factor them in, but you get your market capitalization at the end. Okay, so just eyeballing those numbers, there's not a big change, is there? And in fact, when we scale up our starting index of 1,000, it's not moved very much. And the return is pretty small as well. So it's less than 1%, isn't it? It's 0.211% return. So why is that? Well, that's because we look, where are the big companies? And the big companies, the one with the big market capitalization, well, company E is the single biggest one, and that has pulled the index down, hasn't it? So everything else has been going up, everything else is positive, apart from E. And E is big, so it's pulling down the total. Now that's not free float adjusted, but we can put the free float in by saying, by the way, what is a free float? Free float is the proportion of those shares that are actually available for investors. Doesn't mean they're out there sort of waiting to be bought and sold. What it means really is anything that is locked away because perhaps there's a parent company owns a big slice of, let's say, company G. It may have 5,000 shares, or sorry, not 5,000 shares, but it may have a certain number of shares, but some of them are held within the company structure or locked away in employee share option plans or held by directors or something like that. And the exact rules on free floats are not what you need to know, just the idea that those shares would never really be available for other investors. So we adjust for the free float that's available, and rather than taking the market cap, we take the free float adjusted market cap. So what does this do to our numbers? Well, company E was the biggest, but actually it's not got 100% free float. So that pulls down its importance a bit. So I would expect that we now start to see the other companies having a bit more of an impact. Company F, that one did pretty well, didn't it? So did company G. So we end up seeing a better version of the index. And if you just think back about what all these numbers are showing us, they're showing us some very different values, very different index outcomes for the same underlying companies. So it's why it's so important if an index is being used as a benchmark for investing against or constructing investors' portfolios, this matters actually how we put the numbers together. So we've seen everything from just under a 9% return for the first one to hardly any return, 0.2%, although that did include dividends as well, to 5%. It's very, very different numbers, isn't it? So it is important understanding how these indexes are constructed. So what about this fundamental weighted index? Well, investors or fund managers may be looking at things beyond just the share price. They may be looking at what we call the fundamental factors, and this comes up in a later module. But the fundamentals about the company are what provides its value. So what are the value of the underlying assets? So book value means what's showing in the accounts about the underlying assets or net assets. And what's the cash flow that's being generated, revenue, earnings, basically what is the company generating as that backs up its value. So with the fundamental weighted indexes or indices, I think you need to appreciate the underlying concept, but it is very unlikely that you'd be asked to do any numbers. But we've got a little formula there for the weighting factors. That's basically just saying, for those of you who don't like all the maths notation, basically means that, what are we picking on? One or several of these factors. So for example, it could be that we are looking at the earnings yield, which, if you don't already know, is the company's earnings, which is basically its profits after tax, divided by its share price. So if you were thinking about the fundamentals of a company, you would want companies that generate a lot of profit for the underlying share price. Okay, so for this, a high earnings yield would be a good thing if you were focusing on the fundamentals. So you would weight your index more heavily towards companies that have got high earnings yields. And that's all that little formula means. Now I've just switched to a website here, which is probably one of the most widely known fundamental index providers. So the FTSE RAFI Index Series. And if you wanted to have a little look at this in the real world, you would see pretty much exactly what it says in the curriculum, which is always reassuring. So I'll just read out: index constituents are weighted using a composite of fundamental factors, including total cash dividends, free cash flow, total sales, and book equity value. Prices and market values are not determinants of industry weights. So that's quite interesting. That might be something to just have a little Google around and see what you can see there and see it applied in the real world. Now, finally, what about things that aren't shares? Now, as I said at the start, if you're not all over fixed income, i.e. bonds, yet, then it may be less obvious why, they can be a bit tricky to put into indexes the way that shares are. Okay, but assuming a little bit of knowledge about these at the moment, or just use this as your sort of primer on it, with bonds, companies, especially big companies, often have lots of bonds. So you could have a big company, one class of share, right, would be normal. There could be like 5, 10, 15, 20 different bonds. And some of those might be a issue of bonds that was 10 years ago, that was all snapped up by some pension fund, and none of them trade. It could be virtually impossible to buy or sell these bonds. So for a start, which bonds do we choose? What if there isn't really an active price? And it might be that it's only the more recent bonds and companies that tend to have active prices. So what do we do? Do we keep dropping out the older ones and bringing in the newer ones, which is partly the turnover point? And also bonds pretty much always have an end date. Shares don't. So those bonds, even if they are liquid and there's not so many of them, they come to an end, and companies tend to exist in a permanent source of state of debt. So they will normally pay back one bond by issuing another one. So what do we do when we produce our index? We've got to drop out the old ones, bring in the new ones. So you can just see how you've got loads and loads of very different, rarely traded bonds that we need to keep churning through, dropping out old ones, bringing in new ones. So I'm not saying it's impossible, but it is certainly a challenge to produce fixed income indexes compared to equity. And also bond investors, don't forget bond investors are a very large part of the market. They tend to focus on particular things. So you're likely to have maybe people look at government bonds or corporate bonds or distressed debt. They would have a particular part of the market they'd focus on. They'd have maybe long, if you've seen bonds already, we talk about duration, but broadly speaking, long time to maturity or shorter time to maturity. And that might be the focus. Different levels of credit risk. So the indexes have to be sliced up to represent the way that investors think. So you probably have lots and lots of different indexes relating to all these different sort of variables, different dimensions that you can pick as a fixed income investor. And then with alternative assets, again, if you haven't looked at the section yet, this may not be so obvious, so come back and look at this. But there's less of an obvious weighting choice. Do you choose the amount of commodities out there, or their influence on GDP? What do you use as the weighting? What's a logical way of structuring a commodities portfolio? Also, are you tracking the underlying asset price, or for some markets, it's actually the futures price, which tends to be the more observed figure and maybe reflects what people are actually investing in. Okay. Are you looking at, for example, real estate? Properties notoriously illiquid, but we've got real estate investment trusts which are bought and sold more like shares. So again, what is it that's a better index for what it is you are investing in? And we've always got to be very wary of hedge funds because they don't have to report their results. They may report them to different people, and only the ones that are still alive still report how they are doing. So again, that might lead to a bias upwards in the results because it's only the surviving ones who continue to tell you what their results are. Okay, now finally, just a few other points to sweep up. Published indexes are generally rebalanced on a periodic basis, often quarterly. And again, I'm making reference to the FTSE 100 because it's talked about quite a lot in the UK. And every 3 months, obviously quarterly, companies tend to come in or drop out. And that can cause a bit of a flurry of trading activity, be the same for other indexes. So it can be a big deal when a company comes in or out and suddenly all these index trackers have to buy the shares. And it could be that the trading volume, when it's announced that, so for example, British Land is dropping out of the FTSE, Ocado is going in, posh supermarket delivery chain. And there can be easily 10 times the normal daily trading volume just because of that announcement. So that itself might skew the market a bit when things are rebalanced. So this rebalancing and reconstitution, sort of changing what's in and out. Okay, let's just be clear. Reconstitution is when you're choosing what goes in and out of the index. Rebalancing is when someone investing in the index has to change what they hold to be in line with that index. So the reconstitution comes from the index provider. And that's the point I was talking about there, really, with the British Land and Ocado. And then the people who hold the index have to adjust accordingly. Okay. So when you've got equal weighted, already mentioned how just the movement in the share price without any change in what's in the index can cause all sorts of trading required to keep your portfolio in balance. The one way we don't have to worry is one share in everything. That at least doesn't need rebalancing, but it does have all of these biases that we've mentioned. Okay. And then, of course, the indexes, we can dig down and have different styles, different sectors. And that's great, if you're an investor who wants exposure to potentially, sustainable alternative energy sources. There will be an index for that. And there will probably be an ETF or several that tracks it. So these indexes can be very useful for the retail investors as well. So that ends our masterclass session on the indices module. Hopefully that was helpful and gave you a bit of exam focus and put things into context. And I will see you for the next one.